Hey everyone, this is Jordan. This video is being recorded on the afternoon of Monday, September 16th, 2024. Hope you all had a great weekend. And quickly, I want to thank you all for the kind comments on my wardrobe in the Friday weekly recap video. I really appreciate it. Keep them coming. And I have a lot more fun things coming for you in the future as far as wardrobe, hats, and shirts, and all of that. But that aside, in today's video, I want to talk a little bit about macro and the economy. And, I don't want to talk entirely about gold, but first things first, the key thing with macro and the economy right now is if we see gold continue to strengthen against the stock market and tech stocks, then that's just a signal that it doesn't matter. Recession, inflation, stagflation, all those things, it doesn't matter. The market action is telling us it doesn't matter for gold. Gold has a really good chance to go into a real bull market very, very soon. So that's the key with respect to macro. But enough of me talking. Let's get into some charts. So here is exactly what I'm talking about as far as gold. And I may have mentioned this in the last video or even in a prior video, but I think it's really important to mention this with respect to macro, and we're a gold-focused operation. So we always have to talk about gold. And this is the key. Gold is strengthening in real terms. So gold in US dollars here, had the big move here in the spring. Then it went sideways for a couple months. It's kind of been steadily grinding higher. Some distribution candles here. We did have some concerns. Is it going to pull back here? But it kept grinding higher. It was able to break out of this little consolidation. But the reason why it's resolving to the upside is because gold is starting to strengthen in real terms. So gold against foreign currencies here, we can see here, it's been going sideways since the spring, since that impulsive move up into an April peak. Gold against foreign currencies peaked right here, but this is a very bullish consolidation. Now it is broken out. And so it is broken out, so we'll expect this to continue to trend higher. So that's a good sign because, again, this was going sideways for 4 or 5 months. Another example, gold against the equal weight commodity basket. Now, commodities have been weaker. I'm going to talk more about commodities shortly. They had been weaker than other markets and asset classes, but this was consolidating bullishly. So this broke out here in the summer. A new, like a 3-year high, gold against commodities. So very good sign for gold. Look for that strength to continue. But people, we know it always comes down to gold against the stock market. And I have two ratios here, gold against the S&P 500, but also gold against the equal weight S&P 500. So gold against the equal weight stock market. How is gold performing against the stock market when the 500 stocks are all weighted the same? And what we see here is a beautiful bullish setup here. This is just a beautiful bullish consolidation. Cup here, another cup. You could call this a potential handle. I mean, whatever it is, it's bullish. But I just love how this is setting up for a nice breakout here, and that would be a breakout going back to 2021. So that's a 3.5 year breakout potentially here. So gold is getting very, very close to that. So I assume this is going to break out first, and then probably this here, which this has been a bugaboo for me and gold bugs for a really, really long time. That just damn stock market. It won't underperform gold. It's been hanging in there against gold for so long. But we can see this is another one that's been consolidating for, now we can see almost 3 years. So call it 2.5 years. It's setting up here, similar to this pattern. Not quite as strong. This is a much stronger pattern. The reason being because you have a move up here and then this consolidation, whereas here you have this move down here and then this consolidation. So this is definitely stronger. This is still potentially bullish. We can see how this is setting up. It's got to surpass 0.48 first, then 0.51 here. But people, when we get this thing breaking out, this one will follow. And then we know gold is in a new real bull market, and we can worry much less about, is it going to be inflation, stagflation, recession, rate cuts, are they going to hike, blah, blah, blah. Yeah, but, given that subject matter, that's something I'm going to get into right now if you want to hear about that. Okay, so thinking about where we are in commodities, one thing that's really interesting is the positioning, the net spec position in commodities. if we're looking at all commodities as a whole, so gold, silver, copper, oil, etc. So the net spec position, or the positioning in all of commodity futures, is this. It's actually negative. This is the most negative in, call it 10 years. So that's really significant. And if you think about positioning in gold and silver, it's actually pretty positive. Like, there's heavy bullish positioning in gold and silver, which is normally what you see in a bull market. So if we take that away, the positioning in commodities, X precious metals, is probably even more extreme. So very few are bullish on commodities right now. Okay, this is an interesting chart from Merrill Lynch. And the market doesn't always perfectly follow these cycle charts, and Merrill Lynch says as much. With respect to where we could be right now, where we could be going, I think right now we know that the rate of inflation has been coming down. Maybe it's going to start to pick up soon. We don't have rate cuts yet, but we're going to start getting those rate cuts really within a matter of days. And the rate of inflation is probably in the coming months. You'll look for it to turn up like that. Also, the new president will be spending a lot more money starting, I think, April is when there's time when fiscal can really start to kick in. So if we have a recession before then, that's going to necessitate even more and more spending. So this is potentially where we are with rate cuts and more stimulus here, inflation turning up. However, we could be not that far away from stagflation, because it may take some time for the economy to really start to grow again. Even though all this rate cuts are starting, like I said, we could get fiscal in the next 5-6 months, but it could take a lot of time for that to kick in. If the economy is still weak, yet you have all this money coming in, the markets could start discounting higher inflation, and at some point that could bring about stagflation sometime next year. Maybe if you get a weak recovery, but inflation goes back to 3-4%, and growth is really weak, and you don't have that many new jobs. So we could be setting up for this at some point. Call it the second half of next year. And finally, we can look at this macro chart here. We have a bunch of different data series here. So we have CPI at the top. That's the rate of inflation, the Fed funds rate. Commodities here, the CRB. This is commodities against stocks. Then we have the 10-year yield. These lines show when the Fed started cutting rates, so we can throw in another one in there in a couple days, I'm presuming. And the yield curve here, we can see that's gone positive, so that's not good. And it's definitely not good if it goes like that, as I've said in other videos. There's elements of each of these past recessions. I don't think we're fitting any one perfectly. If you think about, so commodities have corrected, they've kind of stabilized here before a rate cut. There's some similarity to this right here, where they had this huge move in 2006, then they sold off, rate cut, then you had a big move up, then you had a recession. So that's also a possibility, where you get rate cuts and then you get this burst in commodities and in asset classes, then you get the recession next year. So that's something to keep in mind. With respect to stagflation, I think we have to keep an eye on commodities against stocks. And look, that's been going down here. Maybe this will make a big double bottom and come up like that. And we also have to keep an eye on the 10-year yield. What's interesting is, as the Fed starts cutting, are we going to see long-term interest rates continue to go down because there's a significant recession, or will they start to bottom and turn back up? Because, if the Fed starts cutting and the market gets worried about inflation and stagflation, this yield can start to move back up like that. And then the yield curve here will really blow out like that to the upside. So that would be a signal of stagflation. So the reality, people, is it doesn't matter. Recession, inflation, stagflation, the Fed's going to cut. We are really, really close to the point when the market is just telling us it doesn't matter. It's all bullish for gold. We're in a new real gold bull market. So that's my take for today's Macro Mondays. Let me know what you think. Leave a comment about macro or anything else. And thank you so much for tuning in. Hope you all had a great weekend, and I'll talk to you guys again in the next video.